This is the Alhambra Investments Weekly Market Pulse with Joe Calhoun. And for all of our viewers, I will tell you up front, this one's going to be a little longer than normal because this is our mid-year update. And Joe, you spent a lot of time on the update. You always do. So let's just jump right into things. The S&P, as of today, is now in bear market territory. What do you take from all of that?
Well, I mean, it was kind of inevitable, I think. I mean, we already had the NASDAQ and the small cap indexes were already in bear market territory, so I don't think it's all that surprising. I guess I'm not sure if the Dow actually went down 20%, but the Dow is really not all that relevant. But no, I mean, I think that we didn't have to go here necessarily. But as I said in the piece, I think the Fed kind of panicked last week, and people don't like to see, look, I'm not a big fan of the Fed, but I mean, everybody else sees them as having this huge impact on the economy and markets. And so when they panic, they cause other people to panic too. But regardless, it doesn't really matter that, minus 18, minus 22, I don't know. It hurts either way. So I don't know that it really matters that we're in official bear market territory now, but it's painful.
Well, let's talk specifically about the Fed and this thing they call forward guidance, because, they said they were going to do 50 bips, then they did 75, market reacts, bonds react. It was ugly.
Yeah, the idea of forward guidance is that, hey, the Fed doesn't want to surprise anybody. And so they basically tell everybody what they're going to do before they do it. Now, that is opposed to the way it was when I first got in this business back in the early 90s, when, frankly, they would have an FOMC meeting and they didn't say anything. You had to go and watch the Dow Jones Newswire to watch their market actions to see exactly what they decided, which is, I think, in some ways was better. It gave them the ability to surprise the markets. So now the way it is there's no surprises. So what happens is everybody front runs this stuff. They expect the Fed to do something, and long before they do it, it's already priced into the market. Now, it used to be somewhat priced into the market, but there was always the chance that they would do something unexpected. And I think I think monetary policy would work better if it was still that way, but that's not the way it is. So the way I see it is that forward guidance is one of those things where it works great if they're good at forecasting the future. Well, of course, they're not any good at forecasting the future. So because they're not any good at it, forward guidance ends up being a mess at times like this. So, after the last meeting, when they went up 50 basis points, they essentially, everybody was worried back then that they might go 75. I don't know if you remember, but in the aftermath of that, in the press conference, Jerome Powell essentially shot that down and said, no, 75 basis points is not even on the table right now. So then lo and behold, a few days before this meeting, you get a CPI report that was a little bit hot and the market sold off. And I think the Fed looked at it and panicked a little bit. And they thought, oh my God, we've got to go 75 basis points. So the market thinks we're behind the curve. And so they leaked this story to the Wall Street Journal that they're considering 75 basis points. Now, well, if you leak the thing, go to the trouble to leak the thing to the Wall Street Journal 2 days before the meeting, they're going 75. So they did. But the point is that now, what do we do going forward? What is their forward guidance worth since they just, destroyed it? They told everybody they were going 50, and lo and behold, right before the meeting, they get panicky and they go 75. Well, that means that future forward guidance is kind of useless. They're going to do whatever they do. Look, I like I said, I don't think the Fed has as much impact on the economy as the vast majority of people think. Now, it does have an impact on markets, though. And markets in themselves can have an impact on the economy. So when you have something like this where they panic like that, rates shoot up. The 10-year went to 3.5%. Mortgage rates went to 6.25%. Well, mortgage rates. My mortgage is at 2 and change, from a couple of years ago. But rates basically have doubled. The mortgage rates have basically doubled over the last few months. It's going to put an all stop on the housing market. That can't be good. I know they're trying to slow the economy, but slowing it and slamming on the brakes like that is just not a good idea. So we'll see. I mean, look, rates came down a little bit after the meeting, which gives me it kind of makes me think that maybe they went too far. Now the worry seems to be not so much about inflation. In fact, inflation expectations have fallen. I think the fear is about growth. Now they think the Fed's going to do too much. They're going to hike us into recession. Again, I'm worried more about the self-fulfilling prophecy angle of that than I am that the Fed could actually put us in recession. I don't buy the idea that the Fed can put us in recession. If the market perceives that the Fed's going too far, bonds will rally because they'll be expecting recession. I don't think that's where we are right now necessarily. I think there's a lot of people out there worried about recession. I think, but I would just say that before we get to that point, you're going to see rates fall. So I don't know. We'll see what happens. I do think the Fed. I don't think Powell's been particularly good. I think he's maybe the worst of the last three. Bernanke wasn't good. Yellen was worse, and Powell may be worse yet. None of them seem to have a clue what the hell's going on in the real world.
We're going to get into some very specific categories in a minute. But first, with everything that's happened in the first 6 months of this year, tell me where Alhambra portfolios are.
Well, look, we're down a little bit like everybody else, I guess. I think we're doing better than the average bear. We're down about 10%. We have accounts that are down less than that, accounts that are more aggressive accounts that are down a little bit more. But the bottom line is we're down right around 10%. Look, a 60-40 portfolio that is composed of Vanguard all stock and Vanguard all bond is down almost 20. So I feel pretty good that we're beating, kind of the benchmark here for moderate accounts is the 60-40. We're beating that by a wide margin. But let's make no mistake, I don't like being down. It's great to be down less than everybody else, and that's kind of admirable, I suppose. We kind of did our job, but I don't like to have down years. So look, we got a half a year to go. We got to figure out ways to make money in the rest of the year. But we're positioned as we came into the year. We came into the year positioned defensively. We had sold all of our S&P 500, so we didn't have any really growth stock exposure. We didn't own the S&P 500 growth index. We didn't own QQQ, the NASDAQ. So we came into this year. Our equity piece was almost all dividends and dividends and value. We do own a couple of things that, we own some Japan, which is a small position. We own some financials. We own some biotechs. The biotechs is a long-term strategic position. The financials have not performed all that well, but we felt like that with rates going up, it was a good place to be. It hasn't worked out that well. But again, these are tiny positions in our portfolio, so don't really affect the returns all that much. But the bottom line is we came in defensively. So we had, we're underweight stocks. We have some cash there. We're underweight REITs. We're underweight commodities. The only place we were really full weight and it was in bonds. But even there, we were very short-term oriented, short duration oriented at the beginning of the year. We've extended durations a little bit since then. And frankly, if we get rates to peak somewhere here soon, and I think we're really close to that, we'll probably extend duration again. But we came in defensively positioned. We're still defensively positioned. Nothing's really changed all that much. I think what happened last week, look, we were down, mid-single digits until last week. Last week really hurt because some of the defensive stuff finally took a hit last week. The dividend index took a big hit and value indexes took a hit too. They're still obviously outperforming the S&P 500 and the growth indexes by a wide margin. I mean, the S&P 500 growth index is down over 30%, but we did take a hit last week, and it was, I think, unnecessary. But it is what it is. You have to take the market as it is, not the one you want. And that's where we are. Like I said, I feel like we're defensively positioned. I don't see any reason to really change that just yet. I think we're very close to really turning to more offense. But you got to take your time here. You don't know how this stuff is going to go. You're going to get some kind of bounce in these bear markets. They always happen. I highlighted a couple of them in the piece. During 2000 to 2002, that bear market, and also in the 2008 bear market, we got, big bounces here of 20% plus. And I think, we're going to get one of those too. Even if this is not the end of the bear market, you will get one of those rallies. That always happens. So we'll see.
Well, let's talk specific categories. You talked a bit about bonds. Expand on that.
Well, we started the year with basically 50-50. We had 50% in short-term bonds, which is basically, we classify that as 1 to 3 years. We had 50% in intermediate, which is 3 to 7. We had nothing in the long end. We did that because despite the fact that we felt like the economy was going to slow, we also felt like it was pretty obvious that rates were going to go up. And so normally, if we're expecting the economy to slow, our move would be to extend duration And if we thought it was getting to recession territory, we would even sell some of our risk assets and add to bonds. But that was not the playbook this year because rates were going up. Now, when the 10-year passed 3%, we did extend duration some. Obviously, rates have risen a little bit past there. I think we're about 330 this morning. So maybe not perfect timing, but I do think it's going to turn out to be right in the long run. What we have now is we are 75% in the intermediate. So we move some of that short term into intermediate, and we have 12.5% still in the short end and 12.5% in the long end. We call it a barbell. And so long end to us is 7 to 10 years. By the way, we do not generally trade really long-term bonds. We don't do that because the volatility on those really long-term bonds is almost equivalent to stocks. We want our bonds to be less volatile than our stock positions or our risk positions. And so buying the really long end of the curve is not something we do very often. We might do it if we really thought we were headed for, a deep recession. We probably would do it, but we don't think we're there right now.
All right, commodities and gold.
Yeah, again, it was kind of a weird situation. We've had a lot of things happen this year that just are odd. So one of those things is that we know from history that when real rates rise, gold performs poorly and commodities tend to perform fairly poorly. That's generally because higher real rates tend to be a strong dollar period too. So what we got this year was very interesting. We get the strong dollar, we get rising real rates. Real rates go from minus, I think the beginning of the year was minus 1.09 or 1.07, so negative in that sense. And now we're positive. We've gone up 170 basis points, and gold is still up. Commodities are up big this year in a year with a strong dollar and rising real rates. That is totally unexpected. So what we did at the beginning of the year was we maintained a half position. We have a strategic target, a strategic target for commodities and gold. We cut that in half because we knew that rates were going to go up. And we generally know that in the past, especially when real rates go up, commodities don't perform well. Well, that's why they're called, tendencies. It doesn't work all the time. We stuck to our process, though. Our process says that in that environment, you don't want to own a lot of commodities. So we cut our positions in half. Look, one of the reasons we've done okay this year is because our commodity positions have performed so well. It was unexpected. And even with a half a position, it had a big impact on our portfolios. But if rates continue to rise, or if real rates stay positive, I don't think you should expect gold to do anything. In a sense, rising real rates is a positive sign for long-term growth. Think about that for a second. Negative real rates, it can't be positive for long-term growth. What it says is if real rates are negative, it says that people are buying inflation protection. They're worried about inflation. So if they're investing to protect their assets, they're not investing to grow their assets. That's why real rates being positive is kind of a big deal. Think about what's going on here. Everybody's talking about an inflation scare, and yet all year long, people have sold inflation protection. Tips have been sold all year long. So if people are worried about inflation, why are they selling inflation protection? It doesn't make sense. But the fact that they're not trying to protect themselves necessarily from inflation, but are worried about other things or whatever the case may be, I think is a positive. And I think it does feed into the idea that this inflation is not going to last.
You've talked some about stock. Anything you want to add about the equity category?
No, just that, what we're trying to figure out, I think the most surprising thing this year with a strong dollar, again, something we did not expect and something that history says you shouldn't expect, which is that international stocks have outperformed the U.S. this year, even in a rising dollar environment. The Japanese yen is down 14%, and yet the ETF for Japan stocks has actually done better than the S&P. That's not better by much, but it's better. If you think about it, you lost 14% of the currency and you still are beating the S&P. That's pretty impressive. I guess what I'm saying is that if the dollar starts to fall here, and there's no evidence that is in the cards, by the way, I'm just saying that if it does, I would expect that foreign stocks are going to do quite well because they've done well even in a rising dollar environment. When we turn to offense, the question is going to be, where do we pick up the offense? Right now, in a strong dollar environment, if we turn to get more aggressive on the equity side, I would expect to do that in the small and mid cap sectors sections because their valuations are so low. Uh, Mid caps and small caps are extraordinarily cheap here, much cheaper than large caps still. So I think that if we do turn to offense, that's where we'll turn initially. But if the dollar starts to fall, we'll probably add some international too.
And any other thoughts about real estate?
Yeah, real estate's been a dog this year. Look, we came into the year, again, because we were expecting rates to rise, we came in with a half position, half of our strategic target. We have since added some. When we extended duration, when the 10-year hit 3%, we added some real estate because we felt like that rates were peaking, rates would come back down and real estate would rally. Yeah, it didn't happen. Basically, REITs are down every bit as much as the S&P 500 this year. It's been painful. I do think though that if rates come back down, like as we expect, then REITs will perform well.
And then finally today, do you have any forward guidance for the second half of the year?
Forward guidance. Well, look, I've said this many times. I'm not in the business of predicting the future because I'm not any good at it. Most people are not, by the way. I always am fascinated by people who think that they can tell you what's going to happen. They're essentially saying that they know what millions of people are going to do. Man, as unpredictable as humans are, I don't know how anybody could have that kind of confidence that they can do that kind of thing, but whatever. Look, I think that we are extraordinarily oversold in stocks and risk assets more generally. I think that sentiment is very, very negative about the economy and about stocks, about the markets. These are not conditions that normally have, well, to put it differently, normally we expect to see these types of things at bottoms. It doesn't mean we're at the bottom, though. I mean, we've got a lot of metrics from a sentiment standpoint that say we're near some kind of bottom. It doesn't mean it's necessarily the low. As I said earlier, during just for instance, in 2008, in October of 2008, you hit a very low reading on the number of stocks in the S&P above the 200-day moving average. That's one of the sentiment indicators that we follow. And in November, you got a 20% plus rally out of the S&P. And that was in the middle of what was going on in 2008. I don't see the economic situation as anywhere comparable to what happened in 2008. We don't have a banking crisis. We don't have anything that even approaches that at this point. And I don't think we will. We've just spent over a decade allowing banks and forcing banks to shore up their balance sheets. I don't think that that's in the cards. So if you can get a 20% rally in that environment, you can get a big rally in this environment too. The question is whether you've seen the final low. I would point out in 2008, you made that low in October and you rallied in November, and then you ultimately made a lower low. By the time you finished the bear market in March of 2009, you were down another 20% from that low in October. So I'm not saying that there's not potentially more downside. Of course there is. You can never tell about that. And listen, I don't know if I've said this many times, recession is something that we don't have we don't see the conditions in the market right now that we would expect before a recession if it was imminent. I think there are things that are slowing in the economy and we could end up in recession. But I think it matters too, how deep and how long and so forth. I've said all along, since very early in COVID, that when all these distortions are gone, we're going to end up back where we started. We came into COVID with a 2.1% GDP growth rate over the previous 10 years. We didn't do anything during COVID that would make that better. Workforce participation is still lower than it was prior to COVID. We have obviously seen a recovery in the number of people working, but we're still below where we were pre-COVID. All of that, by the way, is in the service sector and most of it in leisure and hospitality, but it is what it is. We don't have as many people working, and productivity growth has not been all that good. We do have some positives out there in the form of investment that may make future productivity rise and be better than it is or it has been for the last decade, but we don't know that yet. The bottom line is that we didn't do anything to really improve things. We did, however, add a lot of government debt. Normally, I would think that would probably lead to somewhat slower growth than we came into this with. But a lot of what happened during COVID was we transferred debt from individual household balance sheets to the Fed, or excuse me, not to the Fed, but to the Treasury, to the U.S. government. Individuals, households still have a lot of cash. We accumulated a lot of savings during COVID. And if you look at that amount of savings that hasn't been spent, I keep hearing this. People keep writing, oh, the savings rate has falling, and therefore people are complete misreading of what this means. The savings rate is a rate. If the savings rate is 3%, it still means that people are saving 3% of their income. It doesn't mean they're spending down their savings. It means they're saving less than they were when it was at 7%. Doesn't mean that necessarily they're spending down their savings. I think there's been some of that, but we had so much excess savings built up during COVID. There's no way we spent all that. That may mitigate any type of fall off that we see if we head into recession. Maybe it's a very mild recession. I don't know. I would say that this period seems to be very, very similar to the 2000, 2002 period. And that was a very, very mild recession. Would be nice if that's what we repeat.